Comcast Corp is a quintessential example of the kind of stock that every investor might want to own. The orange line on this fast graph is the earnings per share of the company going all the way back to 2007. And you can see the company's generated almost perfect results. Earnings growth has averaged over 17.22%. And we only had one hiccup, which was during COVID, where the earnings actually dropped for the first time. When you put the stock price on the graph, the weekly closing stock prices, you see that the stock price follows the earnings growth of the company, which is why we're suggesting this could be one of the most perfect stocks that an investor could own. Great operating results. The white line is the dividend. Since they started paying a dividend, the company's increased their dividend every single year. Hello everybody, this is Chuck Carnival, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. I'm always looking for value, as most of you who've been watching this channel for some time know, but I also like to look for growth of dividends, growth of earnings, growth of your investment. So today in today's video, we're going to cover Comcast. And according to Morningstar's company profile says Comcast is made up of three parts. The core cable business owns networks capable of providing television, internet access, and phone services to roughly 60 million U.S. homes and businesses, or nearly half of the country. About 55% of the homes in this territory subscribe to at least one Comcast service. They acquired NBCU Universal from General Electric in 2011. NBCU owns several cable networks, including CNBC, MSNBC, and USA. The NBC Broadcast Network, several local NBC affiliates, Universal Studios, and several theme parks. Sky, acquired in 2018, is a dominant television provider in the UK and has invested heavily in exclusive and proprietary content to build this position. The firm is also the largest paid television provider in Italy and has a presence in Germany and Australia. So you can see here on the fast graph, this is a very interesting company and a quintessential example of a growth stock. Growth has averaged over 17%, as I said. Current dividend yield is 1.96%. And most importantly, the company has recently come into attractive valuation. It was moderately overvalued after coming out of COVID and the big drop in COVID when it was really undervalued. And now you can buy Comcast today at a very attractive valuation. The company's forecast is to continue growing earnings at over 17% a year for at least the next 2 years, and the long-term trend line growth is almost 15%. So what we have here is the classic example of a growth stock trading at a very reasonable current price. The analyst scorecard for this company has been very good. Other than coming through the COVID where we had one drop in earnings, the scorecard has been almost impeccable. So, the analysts tend to be very reliable in forecasting this company. If you're looking for historical performance, the stock has performed in line with the stock market on this long-term performance. But I want to make a point about that. That's going back to 2007, before we came into the Great Recession when the stock was overpriced. Let me take 2 years off of this graph and come to a point where coming into the recession or just coming out of the recession of 2008, Comcast was attractively priced. And now when we look at our performance, a $10,000 investment would have thrown off $8,000 in dividends versus only $5,000 for the S&P. It would have grown to $60,000 versus $50,000 in the S&P. Gave you an annualized rate of return without dividends of just under 15%, outproducing the S&P, and it would give you growth and dividends. So the combination of two, almost a 16% annualized rate of return versus 14.45. Now this is especially important because if you looked at the overall stock market itself, there's a significant difference that you should look at when you're comparing the performance. Like I like to say, measuring performance without simultaneously measuring valuation is a job half done. If I look at the S&P 500 over this time frame and I go to the historical graph, like Comcast, you could have bought the S&P 500. It was very reasonably priced. But in contrast to Comcast, the S&P 500 has now become dramatically overvalued because the price is significantly above the orange line. Growth rate of the S&P 500 has only been 7.87% compared to Comcast's 17%. But because the market is so overvalued and risky, in my view, the rate of return for the market was almost as good as Comcast over this period of time. But Comcast dramatically outproduced it, or simply outperformed the S&P 500, and it did it during a time when Comcast is actually undervalued. So measuring performance without simultaneously measuring valuation is a job half done. And I think that's really important. Comcast is attractively priced. The stock market, as measured by the S&P 500, is dramatically overpriced. So even with that big disadvantage that Comcast has relative to valuation of the overall market, the company still outperformed the S&P 500, generates significantly more dividend income, more capital appreciation, etc. But best yet, this stock is attractive today. If you're looking at what your rate of return might be going forward, it could be double digits for the next couple of years. In contrast, if we go back to the S&P 500 and look at what the S&P 500 is forecast to do, it would be forecast to give you a negative rate of return over the next 2 years. So Comcast represents a quintessential example of a great growth stock that's also attractively valued, that you can buy today with confidence with a nice 2% dividend yield, and buy a dividend that has grown at approximately the growth rate of about 18% a year. On average and compound average growth rate, both have been in excess of 18%. So today's video features Comcast, one of the largest cable and TV companies in the world, and does worldwide business with a tremendous historical growth rate, and the market has brought it back down into attractive valuation. So this is one you might want to research further and consider investing in if you're looking for both growth and dividend income. The dividend has consistently grown every year since the company started paying one. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this video. If you did, give me a like, ring the bell so you can be alerted to future videos. Subscribe to the channel if you don't already. And you might also want to take a hard look at subscribing to Fast Graphs. Fast Graphs gives you an instant look at what the company that you're considering investing in looks like in the past. Hope you enjoyed this video. Thanks for watching.